Welcome to Willis Weighs In, where we discuss controversial and newsworthy tax planning topics. I'm Ben Willis, contributing editor for Tax Notes. Today, we'll be discussing tax reform possibilities post-election with Victor Fleischer. Professor Fleischer currently teaches at University of California, Irvine School of Law. He is well known in the tax planning community for his carried interest elimination proposals and several prolific articles and op-eds. Amidst his career as a practitioner and professor, he served as the Democratic Chief Tax Counsel at the U.S. Senate Finance Committee, alongside Tiffany Smith. In fact, he and I worked together there in that office for the majority of 2017. So, without further ado, Vic, thank you so much for joining us on today's show. How are you?
I'm good. Thanks for having me. It's a real pleasure to see you again. It's been a couple of years, and looking forward to our conversation.
Same here, absolutely. So why don't we just dive in? I know a lot of folks are curious as to thoughts on what's going to happen if the Trump administration remains with respect to tax rates, which I think is pretty clear that he wants to continue reducing tax rates, which he's been successful in helping do through the Tax Cuts and Jobs Act. And then alternatively, what former President Joe Biden and Senator Kamala Harris would advocate for if they were to make it into the White House. Obviously, I think one of the biggest things on folks' mind is the largest tax break inside of the Tax Cuts and Jobs Act, which I view as the corporate tax rate cut from 35%, a top rate of 35%, was slashed by 40% all the way down to 21%. And so Biden and Harris have discussed increasing that rate up to 28%. And so my question for you is, what are your thoughts on the likelihood of that happening?
To begin, I think we have to talk about what happens if the Democrats take the Senate and what happens if the Republicans hold the Senate. So if Biden wins and the Republicans hold on to the Senate, which is definitely a strong possibility, then we're not going to see that much change. The scenarios where we're going to see a lot of these changes really depend on the Democrats being able to take the Senate as well as the White House and then use a budget reconciliation bill in the same way that the Republicans did in 2017. So there's a few ifs there before we get to the question of can we raise the corporate rate to 28%. But I think the betting markets are showing something like a 50-50 chance of a Democratic clean sweep. So worth talking about. If that happens, I think the increase in the corporate rate is going to be the first thing on the agenda legislatively for a couple of reasons. First of all, it's relatively simple compared to some of the other things that we might talk about later in our discussion. Just changing the rate doesn't require the sort of structural reform or major change that some of the other proposals might. The sense that I have is that people think 28% is a safe rate. 35%, where we were, was viewed as too high by folks on both sides of the aisle. The Obama administration had suggested moving to 28%, and so I think that's why 28% is the number. The Senate, of course, might end up putting pressure to keep it lower than that. So I'm not sure it's a given that 28% is going to be the number, but I think it has the potential, especially combined with some base broadening measures, to raise a lot of revenue. And that's important because Biden has ambitious plans to try to rebuild the economy and spend a lot of money to try and get people back to work. and ultimately that has to be paid for. And so folks are going to be looking for revenue. Corporate rate increase is going to be at the top of the list.
Do you think that the 28% rate would face any obstacles in Senate or could cause any economic disruption for companies across the U.S.?
Yeah, so it's an interesting question to try to think through what the reactions are going to be. I think that, while we're still in an economic recession, there's going to be some pushback about tax increases while we're still coming out of the recession. But there's a lot of reason to think that the economic effect of increasing the corporate tax rate is not going to be dramatic. So if we think about it the other way, what was the economic impact of the corporate rate cut to 21%? Well, it's still early in terms of trying to understand the economic data that we have. And the data that we have is muddled because Trump had other policies, the trade war with China in particular, that certainly hurt the economy. And so it's a little bit hard to disentangle the two effects because they're going on simultaneously. But the data that we do have seems to suggest there wasn't a big increase in capital expenditures. And that was sort of the theory behind the rosy economic growth projections that Republicans were putting out there in 2017. The idea is that if you reduce the cost of capital, that you're going to see increased investments, you're going to see increased investment by companies in research and development and other advances that can improve productivity and lead to greater economic growth. One thing that I've been thinking about is the effect of being in such a low interest rate environment for a long time. So companies have not been, it hasn't been that tight in the capital markets. They've been able to borrow money when they want to invest. And so maybe the cost of equity capital has just been less important in this environment. In any event, I think the economic growth from the corporate rate cut hasn't really materialized to a large degree. One has to think that there's an effect on the margins, so there has to be some effect, but it doesn't seem like it's been that large. The flip side of that is that increasing the corporate rate from 21 to 28% is also not going to have a dramatic economic impact. I think the long and short of it is the big cut in the corporate rate was mostly a transfer from the Treasury to corporate shareholders, and increasing the rate is mostly the reverse of that.
Yeah, that's helpful, and I'd agree with respect to how big of an impact it's had on the economy and individuals. Obviously, people measure these things using different barometers, but as far as the one that was widely held out or early on for advocating for the Tax Cuts and Jobs Act was that average pay increase of $4,000 across the board, and I don't think that's materialized.
Yeah, I'm still waiting for the increase in my paycheck. But what about on the tax planning front? Have you observed a lot of changes? I know, and congrats on your success with tax notes. I always enjoy reading the stuff that you're writing about. Have you seen a lot of change in the way that companies are planning around the new lower corporate tax rate and the other changes?
That's a great question. I've talked a bit about some of the impact that the GILTI regime has had on corporations and their ability to take advantage of the mechanics of that provision. And so, as I'm certain you're familiar with, there's a component built in there where they're intending to tax intangible assets, and so that's the name global intangible low-tax income, and whether or not that's had the economic effect that was intended is, I believe, questionable at best. I think one of the main reasons we didn't see this projected $3 to $4 trillion influx of capital from moving from foreign offshore entities to inbound into the U.S. through the Section 965 repatriation tax after that hit, and then you have your tax-free dividends under Section 245A, is because a lot of that money had a benefit being offshore, not only being in low-rate jurisdictions and the fact that it's a global calculation as opposed to per country, but because this money could be utilized to invest in qualified business assets and basically depreciable property, and a return of 10% is permitted on that. I'll put this question to you. Would you say that that figure is something that taxpayers might appreciate?
Yeah. So I've been concerned about this QBI rule from the beginning, because it gives companies an incentive that runs counter to what we think is good policy, which is that we don't want to encourage companies to invest offshore. So I think you laid it out nicely. The backdrop here is we're moving into a territorial approach. And so GILTI is designed to make sure that companies don't abuse that too much by shifting their intangible assets offshore in order to profit shift from the US to an offshore jurisdiction. The problem with the QBI rules is it gives companies an incentive to build factories or make other investments in tangible property offshore, because they get a deemed sort of return on that investment, which is going to reduce their taxable income. And so if you're a corporate manager and you're thinking about whether to build a factory in the US or whether to build a factory offshore, you get an extra return on your investment for doing it offshore. And that seems like a design flaw that ought to be fixed.
And I think that's exactly what is going on with respect to the Biden-Harris proposals. I think they've not only proposed eliminating the 50% deduction under Section 250, which would cause a 21% effective rate under GILTI, but also eliminating this QBI benefit and really distinguishing between businesses that are focused on largely on tangible property versus intangible, and shifting those assets around and the proportions in order to maximize the benefits that are available under the GILTI regime. In other words, to eliminate GILTI by not having so much investment in tangible relative to your, or in intangibles relative to your tangible assets. And so it's definitely been interesting. And we're talking so much about these other low tax jurisdictions and the possibility for gamesmanship there. You have to really wonder, did we position ourselves well as a competitive country whose markets are sought after and ripe for investment by a lot of foreigners? Foreigners comprise a large percentage of ownership of publicly traded companies in the U.S.
About 35%. I was discussing this in class the other day, and one of my students sent me a link, and that's really quite impressive. And generally speaking, this is good, right? We want to be a place that is attractive for investment from abroad as well as here.
Yeah. I agree, and I think the question is, are we now too attractive? In other words, are we so low tax that we really didn't have to bear this burden, which is causing these massive deficits, by losing a good portion, obviously not the bulk of our revenue that comes into the fisc, but corporate tax rates haven't been this low since 1939, and so for us to drop all the way down to 21% when rates have historically been well above the 50s on average, for the bulk of that time anyway. You got to really wonder. It doesn't seem to be providing the benefit to workers. It provides benefits to a lot of foreign investors, that's for sure. And then the question is, what was the impetus behind that? And I think it was to be more in line with OECD countries and other countries that are places for investment and competitors, so to speak, of the U.S. and our trading partners. And I just don't believe that actually occurred. I think that as opposed to putting ourselves somewhere closer to the middle of the pack, we're now much lower than that. And I think a lot of that has to do not only with respect to solely that 21% tax rate, which so many people focus on, but also just the other taxes that most countries impose.
Yeah, so I think you're right that you want to think about the overall tax burden that a company and its workers are going to face in the U.S. versus other jurisdictions. Cutting against that point maybe is the question of inversions, because we rely on corporate tax revenue. As that rate goes up, you have to worry about companies trying to invert. And so, if you think back to a corporate tax rate at 35%, you've got a really strong incentive to try and do an inversion, or to incorporate your company offshore to begin with, and try and avoid U.S. tax that way. So there's less concern about that at 21%. I think 28% is somewhere in the middle, and I think it'll be important to make sure that our anti-inversion rules are working. And more broadly, I think a moderate approach is appropriate for trying to make sure that companies that are headquartered in the U.S. And founded in the U.S. Continue to find the U.S. a competitive tax environment. I think the Biden proposal of 28% is within the reasonable range. I mean, keep in mind, sometimes I have conversations with people who are further to the left, who say, look, we should increase the tax rate on corporations to 50%. And not only does that create all sorts of problems within the corporate tax regime, you're putting an awful lot of pressure on companies to try and conduct business in the partnership form. The bigger that rate gap becomes, the more companies you see trying to do business as publicly traded partnerships or just large privately held partnerships. So I think the corporate rate of 25%, 28%, I think those are the right numbers to think about.
Yeah. And this may align with some of the historic corporate integration type proposals over the years, but I know I've argued that there should be some parity between the taxation of business income. And so if there's going to be an adjustment to the corporate tax rate, they need to keep pass-throughs in mind, just as they did in the Tax Cuts and Jobs Act, by selecting a certain number of types of businesses to benefit from a reduced rate.
Yeah, I mean, that continues to really bother me, and I'm sure you're not surprised to hear that. But the 199 Cap A deduction, I could sort of, obviously we weren't in the room because we're on the wrong side of the aisle. But when you think about the way that the 2017 bill was put together, you can see they're kind of aiming for parity between partnerships on the one hand, where you're paying tax at the individual rate of top rate of 37%, versus the corporate approach where you have originally was going to be a 20% corporate rate, and then a 20% tax on capital gains or dividends on the back end. And so if you do the math, that kind of comes out the same. Now that doesn't account for the deferral benefit. If you're organized as a corporation and you retain your earnings, you get to reinvest those earnings without paying the shareholder level of tax. And so there's a way in which a corporate tax of 20% can become a sort of tax shelter for investors. But you can see the original design provided at least rough parity between the two. And that's a sensible approach, because you don't want companies to be making choice of entity decisions on the basis of tax, or at least dominated by tax. You want them to be choosing the form of organization which is best for the business. But then and maybe this is on my mind because I was teaching choice of entity yesterday, the 199 Cap A deduction comes back in and says, well, if you're in the kinds of partnerships that we like, that we want to, I guess, subsidize, the rationale in part being, I think, to avoid too much of a benefit for service industries. So if you're a manufacturing partnership, you can take this 20% deduction, and that starts to tilt the playing field back again to partnerships. And it's still an interesting question whether overall you're better off as a partnership or if you're better off as a corporation. And there's lots of moving parts there, like the qualified small business stock, Section 1202 exclusion for capital gains. But the 199 Cap A deduction, it's really hard to justify in terms of policy. I think it was viewed as necessary to try and get votes for the last few Republicans, like Senator Johnson, who was holding out to get something done for partnerships. So I'm not a big fan of 199 Cap A, and I hope that's on the list of things legislatively to try and roll back.
Agreed completely. Well, I certainly can't have a discussion with Victor Fleischer before the world and not bring up carried interest, which I mentioned at the beginning of our show. I guess I'll start off with an obvious question. I know the past two presidents have focused on eliminating the carried interest loophole. I think largely based on your writings that go back nearly 2 decades now, and I and all of the candidates, I think, in the last election actually were for it as well. Was the Tax Cuts and Jobs Act successful in creating 1061 to eliminate the carried interest loophole? Does 1061 actually eliminate that loophole?
Well, thank you for the softball. Obviously, I'm not happy with Section 1061. In fact, it seems like it was designed to burden as few people as possible while still looking like Congress is doing something related to carried interest. So when you change the holding period from 1 year to 3 years, that has an effect on very few private equity and venture capital funds, because they typically hold their investments for longer than 3 years. If you have a fund invest in a company for less than a year, that's always been short term. And so Section 1061 only applies to this window between 1 and 3 years. So it could affect some activist hedge funds who sometimes hold positions for a period of time between 1 and 3 years. But it really seems like it was designed as a sort of fake tax policy to give the appearance of doing something while actually doing very little. It does create some headaches for funds that want to exit between 1 and 3 years, and it creates a conflict between the fund managers who have a personal interest in holding the investment. So let's say that your fund is ready to exit an investment and it's been 2.5 years. The individual fund manager has an incentive to try and delay until clearing the 3-year mark, whereas the investors are mostly tax exempt. They don't care about the treatment. They're not affected by 1061 anyway. And so, it creates an incentive for the fund managers to breach their fiduciary duties to their investors. So it's deeply problematic. And I think if the Democrats take the Senate, I think the most likely scenario, if they take the White House and the Senate, would be to return back to the legislative proposals that have evolved, since 2008. And I think Senator Baldwin, I think hers is the most recent Democratic bill. That would be the most logical starting point. And I think it's worth going back to those approaches, because simply changing the character from short-term to long-term capital gain doesn't fully reflect what I think is the right policy, which is that this is really disguised labor income. And if it's disguised labor income, it should be treated as ordinary income. And that's important, because then you're picking up not just the rate increase to ordinary rates, but you're also picking up 3.8% Medicaid tax. So all in all, 1061, I think, is really bad policy, and I think it's cynical policy. So I do hope that the Democrats have a chance to reintroduce carried interest legislation.
No, that makes complete sense to me. And if you combine the 3.8% with another proposal that Biden has on the table, which is to shift the FICA taxes from the currently regressive tax that it is on low-income individuals, and shift it to those making above $400,000 a year, then that would truly tax it as labor income, and so it could definitely have a big impact. And I've actually been asked, even under the Trump administration, whether or not they might take additional actions to keep the promise to eliminate the carried interest loophole that was made. In other words, and I don't think this is the case in the administration, but whether or not they have fully eliminated it, if they do not believe that, are there other measures that they could take? And I believe that was largely the focus of some of your prior write-ups on this point. In other words, whether or not Treasury had the authority to eliminate the carried interest loophole without tax reform, assuming, for example, maybe Trump wants to do that in another term, or assuming Biden and Harris make it into the White House, they would want to do that.
It's interesting to think about. So I think the most likely, I don't think the Trump administration is going to take any action here if they continue. I think the scenario that is worth thinking about is if the Democrats take the White House, but they don't control the Senate, or indeed even if they do take the Senate, it might be worth thinking about what they might do just through Treasury authority. I mean, if the Democrats sweep, you and I know that we have all these tax reform issues that are pressing in our minds, but Congress is going to have a lot to do. We're still going to be in this pandemic recovery, and so I think there are some things that are going to be at the top of the agenda, like the corporate rate, but legislatively, carried interest might not be at the top. It's not a huge revenue raiser. I think it raises a lot more revenue than JCT has projected, but it's not, in terms of scale, quite as large. But symbolically, it's important. In terms of fairness, it's important. In terms of making sure that those at the very top are paying tax consistent with our progressive tax system at a high rate on their labor income. And so there could be a push within the administration to have Treasury look at this and see what they can do through regulation. So back in 2015, 2016, while Treasury was looking at the Section 707 regulation, 707A2A gives actually directs the Treasury to come up with regulations that discuss when a partner who is performing services for the partnership should be treated as one acting not in one's capacity as a partner, in which case the allocations to that partner would be treated as if they were payments for services rendered. And my position then, before Section 1061 was in place, was that Treasury had wide discretion here to recharacterize those payments as service payments and treat them accordingly. And that would be different than the approach that they ended up proposing, which focuses on entrepreneurial risk. And if you have a smidgen of entrepreneurial risk, that is enough to make it that allocation of income to a partner a 704 allocation, in which case it can get capital gains treatment. I think a hard question for me is whether Treasury still has that broad discretion, or because Congress passed 1061, did Congress effectively endorse the status quo treatment of carried interest, which means that you as long as you have a little bit of entrepreneurial risk, we're going to treat that as a partnership allocation, including with the character of that allocation being determined at the partnership level, and thus conveying capital gains treatment. So I'm a little bit concerned that Treasury has been constrained by Section 1061, and I guess I'd be curious for your reaction to that. And do you think Treasury has the authority to act through Section 707 to change that allocation?
Tough question.
Yeah.
Well, I guess I'll start off by saying I think that the current Treasury would certainly think that they have the authority to issue whatever rules it wants to get to the answer that it does, notwithstanding the general partnership rules relating to, I
know you've been a tough critic of some of the actions in other areas that they've taken. It's a pretty broad, I guess, some creative readings of the text, I guess.
I mean, guaranteed payments to partners are governed by 707 in part, and that's the provision that we're talking about that I agree gives Treasury the ability to address the carried interest loophole, notwithstanding 1061, which I'll get to in just a second as to my thoughts on that. But the Tax Cuts and Jobs Act came out with the new interest limitation under Section 163J, and that provision, ignores the partnership rules with respect to guaranteed payments and treats partners as merely recipients of interest payments when it wants to, based on an ambiguous principal purpose test that completely ignores business purpose and legitimate reasons for transactions. And so, with that in mind, that's one view. But even what I'll say under a more conservative view of guidance, I would still argue that 1061 doesn't prohibit the ability to utilize the authority granted to Treasury in 707A2 to issue regulations to determine what is in substance a partner and a transaction engaged between a partnership and a partner, which is really what that provision is all about. Determining the substance, whereas 1061 is really extending the holding period on a determination that I think becomes and is made before you even reach 1061. And maybe there's some arguments to the contrary there, but in defining applicable partnership interest, it assumes there's a partnership interest, and that the partnership isn't interacting with a partner as a non-partner, and
Right.
you know what I mean?
Right. So I guess then the question that I would come back to then is like, what's the universe of cases where you could have somebody who is treated as a partner under our hypothetical 707 regs that change that approach and say that fund managers are not to be treated as acting in one's capacity as a partner. So you think about that universe, and then you think about the universe of people who might be subject to 1061 with an applicable service partnership interest. If the regulation makes the 1061 universe a null set, then it seems like that might conflict with congressional policy as enacted under 1061. I think one place we definitely agree is if the Treasury acts to address fee waivers, for example, where fund managers convert their management fee into capital gain by taking a special allocation of additional carried interest when they waive the fee. I think there's no question Treasury has the authority to address that and some other abusive practices. I think it's interesting to think about how much further they can go. And maybe you're right that we can think of these as operating on two different tracks, in which case their Section 707 authority remains pretty broad. I mean, just go back to the text of the statute. Congress, when it passed Section 707, said, the Secretary of the Treasury shall promulgate regulations addressing these questions. So that's a very broad delegation of authority. And so maybe that still governs the question.
Yeah, I know some people hold the view that unlike the Tax Cuts and Jobs Act, because there is a decent amount of actual legislative history underlying some of these rules, 707 and other partnership concepts, but just whether or not the legislative history incorporates this sort of discussion. And my starting point there is, does it matter? Isn't the language clear enough in the statute, the regulatory grant, such that you really don't need to look to the legislative history to see if they spelled out who should be treated as a partner or a non-partner? That's why they delegated the authority to Treasury. And so I realize in some instances they gave more clarity on that, and I appreciate that. But I was always a proponent of your articles before 1061 and their position, and I still think there's some room even after it.
Yeah, it'll be interesting to see. I mean, I never thought when I wrote that article that it would get the attention that it did, let alone that we would still be talking about it years later. So for better or worse, I think carried interest is going to continue to be a topic of interest for the next few years.
Well, I will end by thanking Vic once again for joining us here on Willis Weighs In.
Thanks for having me.
For those of you who are watching and listening, please do not hesitate to reach out to me. You can find me at Willis Weighs In on Twitter, or you can go ahead and shoot me an email at ben.willis@taxanalysts.org. Thank you so much.